Hey guys, it's Bill Lewis at Choice One Mortgage. I wanted to show you a really interesting purchase loan scenario that we worked on recently, and a way that we figured out how to save a buyer quite a bit of money, both upfront and over the life of their loan. The buyer came to us saying that they wanted to get a 30-year fixed with a 20% down payment in order to avoid paying mortgage insurance. And it seemed like a perfectly reasonable scenario until I looked closer and realized that the home they wanted to purchase was $400,000, and that 20% down payment came to $80,000. They only had about $90,000 in the bank in all of their accounts. So this down payment was going to pretty much deplete everything, all of their reserves, all of their savings. And so that's fine, and some people may choose to do that, but I just felt like they needed to see an option where they could maybe keep more money in their pocket after closing in order to have it for an emergency, or if they wanted to buy furniture and other things for their new home. So I put numbers together for a lower down payment, and I wanted to try to figure out a way where that could make sense. And I also wanted to avoid mortgage insurance. So that was the key. So I put together a scenario where they would use only a 15% down payment, which was about $60,000 on their $400,000 purchase. And so right off the bat, we saved them 20 grand. It's perfectly good idea. And in order to make the loan appealing, meaning we couldn't raise their payment or make their expenses over time increase, we had to buy down the interest rate. So the scenario number one with 20% down, they qualified for a great interest rate, 3.999 with no points. To make this scenario number two work, we got them all the way down to 3.25%, but they would have to pay points or buy down the interest rate. And so the cost for 3.25 was $10,000. Now that may sound really high, but stick with me because there's a method to the madness. Look at the numbers. The down payment was going to be $20,000, so they'd have $20,000 more in their pocket at closing. But $10,000 of that would have to go towards buying down the rate. So the net effect after closing is they'd have about $10,000 more to use towards furniture or other things. But look also that the lower interest rate, even though the loan amount was higher, the lower interest rate was going to save them about $48 a month on their monthly payment. So right off the bat, the numbers were starting to make more sense. I couldn't just cast away this idea because it wouldn't help the buyer. But the real benefit to things like this comes over time. So this kind of solution is really only relevant, or usually only relevant, to buyers that plan on being in their home for the long haul. If you're buying a home and think you may upgrade or flip it within 3, 4, 5 years, an idea like this may not make sense because you won't have enough time for it to pay for itself. But let's look at the numbers on this particular scenario over time. So after the first 5 years, you can see that they would save about $8,600 in interest. This loan cost them $61,000 in interest. The scenario number two only cost them $52,000. And they reduced their balance here by $30,000. This scenario, they increased their balance reduction up to $36,000. So what do buyers or borrowers want to do? They want to pay less in interest and they want to pay more towards their principal. So already after 5 years, this is starting to make sense. They saved $8,600 in interest expense. They also saved $48 a month over 5 years, added up to $2,800 a month. So their overall savings after 5 years was $11,500. They've already paid for essentially the buy down, the cost for getting this super low rate. And by the way, at 3.25, there's not going to be any incentive for this homeowner to refinance because they're probably never going to see a rate that's low enough for it to make sense to refi. So I felt pretty comfortable knowing that if we can get them that low, that they're never going to be out of that loan unless they move. Look at the numbers after 10 years. The interest expense is almost $17,000 lower. Their balance is their balance reduction, principal balance reduction is $5,700 more. So the balance reduction here is $67,000, and on this loan it's $79,000. So they've paid almost $12,000 or whatever more towards their principal balance. The payment savings, that $48 a month is adding up over 10 years, is $5,700. So when you look at the overall savings after 10 years, it's already up to $22,000. Amazing. So look at the bottom line though. Over 30 years, when the loans are both paid off, scenario number 2, the loan that they ultimately chose, saved them $37,000 in interest expense and $17,000 in payment savings, or will save them. So their overall savings over the life of the loan is going to be close to $55,000. So, there's no argument to be made that this doesn't make sense. The only thing that the buyer has to watch out for is they need to be in the home for the long haul, and in this loan for the long haul, in order for it to make the most sense. So give me a call anytime. It's Bill Lewis at Choice One Mortgage. My phone number is area code 800-224-9999. You can find us online at www.choiceonemortgage.com. Thanks.